So PPI, or the Producer's Price Index, came in extremely high today, which surprised me a little bit. CPI came in hot 2 days ago, which didn't surprise me so much. I'm pretty impressed with how the markets reacted, and I'm going to explain why I think that happened. And I'm also going to talk about real estate a bit today. I watched a video from a guy I really like. His name is Travis Spencer. He does real estate mindset. I like the data he points to. He and I just often disagree in terms of direction and what we think is actually going on with the market. So stick around while I talk about those things and see if you like it. Good morning. My name is Adam Kahn, and I'm the Rational Investor. Today is Friday, February 16th. I can't believe how fast the year is going. I said in another video I would talk about that, and there's a mathematical reason why time feels like it actually does go faster the older you get. So, a mathematics teacher, when I was younger, kind of explained it to me, which is your brain only has the ability to understand in its own capacity. What that means is from year one to year two of your life, that year is 50% of your life. But from 50 to 51, that's only 2.5%. So the time actually is going faster in terms of what your brain recognizes and understands, which really sucks because the older you get, the faster it goes, the quicker you come to the grave, which is what goes through my head all the time. Anyway, really, I want to talk about CPI and PPI as well as the housing market, not rattle on about time and brains and how they work. And I'm not even 100% sure I'm correct on some of it. But before I forget, do me a favor. If you haven't already, hit that subscribe button, smash the like button. As you guys know, that helps YouTube's algorithm, helps people find the channel. And if you're enjoying the content, I really appreciate that support. It's really cool. I've been super excited to see how the channel's been growing, actually. So I want to thank you guys as well. So PPI, or Producer's Price Index, came in high today, which was a bit of a surprise and a good surprise to me. And I mean negative, but good meaning, bigger than expected. Um, and honestly, that's a bigger concern in terms of inflation and what's going on with the economy, because that works with the core inflation data and what the Fed actually looks at. It also pushed out when they think the Fed might cut rates, and it may continue to push it out further and further and further if that continues to come in like that. So the reason I'm still bullish equities, no matter which way that goes, is the markets will get really excited if those numbers start coming down and they think that the Fed's able to start cutting rates. But if they run into the position where 3 to 4% inflation is about where we are, and no matter what the Fed does, and if they don't cut or raise rates or do anything, that it stays there, the inflation allows margins to continue to get better and better for corporations and companies, and stocks are a great hedge against inflation. If prices continue to go up, companies like Target or whomever, this is not financial advice. I just threw Target out there because it's a company I happen to like. But they continue to be able to raise prices. Along with automation and everything else, they've been able to cut costs in terms of staff and things like that. And if gas prices don't go back up, they've probably lowered their costs of moving products back and forth to stores or delivering it or whatever it is, which will increase profits. And not just for Target, for all the companies that deal with this stuff. So if inflation continues to seep through the economy, not at the 8 or 9% that it was for a little while, but at a more reasonable 3, 4%, if the Fed doesn't have to cut rates and the economy keeps moving along, I see stocks continuing higher. If we actually have inflation start to rear its ugly head again, and the Fed has to go the other route and they have to raise rates, I would worry about a big bad down move coming. But the reality is, if we don't have anything terrible happen other than it sucks and the inflation starts seeping through, same thing. Stocks will make more money, it'll help their earnings, it'll do better at the bottom line, and you'll see prices of the stock market continue to go higher as well. So, in either of those scenarios, I see stocks going higher. Now, let's flip the curve and say the CPI, PPI, and inflation starts coming down, and the Fed's able to cut rates, so long as it's not with massive unemployment, same thing. The markets will get excited that they're able to cut rates and they'll be able to stimulate borrowing, and the companies will be able to go on a different trajectory in terms of trying to grow, and you'll see stock prices go up. So there's very few scenarios that I see outside of massive unemployment and major problems where stocks don't go higher. That's why I'm bullish the equities. Bonds, on the other hand, if we don't see inflation start slowing down, you're going to see rates continue to drift higher. Whether that means just pushing it out further into when the Fed actually is able to cut rates, or if they have to raise, or whatever that looks like, you'll see the 10-year continue to drift higher. Now, one of the things that a lot of people in the mortgage industry, which I'm in as well, but a lot of them point to is that how big the spread between the 10-year and where mortgage rates are. But let me explain a little bit about that because I had an epiphany as to why that's going on. It isn't simply because the banks want better margins, it's because of the inverted yield curve. So banks borrow from the Fed at the overnight lending rate. If the overnight lending rate is higher than where the 10-year is, there has to be a bigger spread between the 10-year and mortgage rates in terms of what the banks have to charge, because the banks are actually paying a higher rate to borrow than what it looks like. Does everybody understand that? Like if they're borrowing at the overnight lending rate and the overnight lending rate is a higher interest rate than where the 10-year is, traditionally, if they're only 2 percentage points above the 10-year, they're going to have to make that a bigger number because they're borrowing at a higher rate when it's normally a lower rate. The normal yield curve is going to have the overnight lending rate significantly lower than where the 10-year is because it would be a natural curve that would slant up. Right now, what we have is straight across and then it comes down at the end. Well, when that happens, they're borrowing at the higher part of the yield curve now. So the margin from the 10-year, which is lower, has to be higher than where it is until that uninverts, which everybody gets scared that that's going to be when the economy collapses and whatever else. I have a different perspective on that. I really don't see that being an indication of now the economy is going to collapse because of the yield curve uninverted. But back to the reason I'm stating that, that's why the margin has spread out more. If they're borrowing at the highest rate or a higher rate in the yield curve, they need to build a bigger margin between what the longer end shows and where mortgages are. Now, in terms of the housing market, I really don't see a collapse coming, and I'll tell you why this time is different. One is the super low interest rates, these golden handcuffs that people refer to. There's plenty of people who got in at really good interest rates who are comfortable with their payments. They're annoyed, like myself, that taxes are going up and insurance and things like that. But the reality is, the actual mortgage is really good. And there's just no reason to move and there's no reason to go anywhere because where are you going to be able to get in at such a great rate? And I think a lot of people saw it. I mean, to be fair, I think the Fed kept it a little too low for too long. I agreed with them when they thought it was, what do you call it, transient. Uh, to be fair, as much as everybody gives them a hard time, I thought so too. The supply chain was backed up, products couldn't move. It made sense that would cause too few products, and the demand was stronger than people expected. And people weren't working because they were scared of COVID, so it took a long time to ramp up production again. Now I think we're past that. So it's interesting that the inflation has stayed at 3 to 4%. It should have come down from 9, which it did, but it'll be interesting to see going forward because I think they're going to have a tough time getting it down to 2. The other thing is the Fed has said they feel like they're going to have to lower rates in advance of it getting to 2 because if they wait that long, they think they'll be behind again. Now, real estate is really local. So when I refer to real estate, please understand my bias is in Las Vegas. We have limited inventory. That is a legit issue. There is not enough inventory for the demand, even with the higher rates. The other thing is the city has grown legitimately, and we don't have ability to just expand and expand and expand. So we will continue to have limited inventory. Now we just had the Super Bowl. We have a football team. We have a hockey team. We're talking about bringing a baseball team in. We had F1 come in. The city is really growing, and we are a vacation destination. On top of that, with the work from home, where would you rather work from home? Nice, warm, sunny Las Vegas or Chicago, which is where I lived for 10 years before moving here, with the rain and the snow and everything else that comes with it? I love Chicago. I had a great time there now, but the thing is part of the great time was the position I was in. When I think of the city, and I love the people, so nothing against the people, but when I think of trudging through the snow and dealing with that winter and everything else, my God, we're in February and I'm going to be wearing shorts today. Like, it's so cool out here. And I mean, cool that it's warm. And the summers that are hot, you get used to that. So I think some of the places that what I perceived as being undervalued years ago, like Florida and Las Vegas and some of the other warm weather places that people didn't really want to move to, I think part of the reason they're booming is people are recognizing these are really nice places to live. My guess is the same is going on with Texas right now because it's warmer weather too. And I think there's still deals in the housing market. My guess is because I've looked a little in places like Cleveland or Cincinnati, where you're in the cold, it's in the middle of the country, you can still get a great deal on a property. The problem is, I don't know that people want to live there other than their families there and they're used to where it is and everything else. But if you weren't from the US and you were just picking a place on the map, I mean, I love California because you get a mix of all of it and you have the ocean. But the problem with California is the taxes, the politics, and the expense. Like, it's just super expensive. I think they've gone a little too far on the political end, and the taxes are crazy out of hand as well. So it's a tough place to live. Florida, on the other hand, you have the ocean, you've got great warm weather. It's a great place. No wonder the prices of homes shot up. And while everybody thinks it's so overpriced, it's hard for me to imagine going back to where it was. You know, look at Hawaii. There's limited inventory, limited space. There's only so much beachfront property. The rents don't make sense to the purchase price. The locals can't afford to live there, but somehow they manage to because it's awful expensive. And I don't ever see that changing. And I think we've made this transition in terms of vacation places like Vegas that I think it's the same here. I don't ever envision a scenario, unless there's some black swan event, where we go back to where it makes sense in terms of the local incomes or it makes sense as a potential rental property. My guess is you'll have to recognize the value of the area and accept that it's going to be a little overpriced for a long time, if not forever. So, my wife and I moved here in 2005 from Chicago. I originally grew up in New York. The reason I picked Las Vegas was because I thought it was so undervalued. You could get really nice property for way under what it, in my mind, should have cost, especially coming from New York originally and then Chicago. Then, after being here, the taxes were lower. There's some things where they make it up a bit, but I think the casinos probably help out and whatever else. And on top of that, the upkeep of the property is so much easier. I don't have to worry about turning on and off the water and things like that, and things don't break as often. So even the ease of life was so much better than what I was accustomed to once I got here. But understand, we actually targeted Las Vegas because I thought it was undervalued. Well, that was what, 18 years ago or something? We're 2024, so 19 years ago. So 19 years ago. So it took 19 years, and COVID really sped it up, but it was happening prior to COVID. Like, prices were beginning to go up already, and you saw it changing. Like, you really did. Once the sports teams started coming in, you saw it happen even more so. And I think that's because you had all those salaries come in. You don't just have the players, but you have the coaches and the doctors and all the support staff that goes around it, looking in the nicer neighborhoods to pick up properties because they need somewhere to live. And again, the thing that I said is, Las Vegas doesn't have unlimited area around it to continue to build. When I look at Chicago in the Midwest, where it just has land after land after land as you move out of the city, there's ability to continue to expand. Out here, we're surrounded by mountains, and on the other side, you hit California really quick, but it's mountains over there. You can't just go either direction so easily. So I guess for me, that's why I'm still bullish the market. At least here, I'm bullish, and then I'm bullish the equities market as well. Now, do your own research. This is not financial advice. I am not a financial advisor. I am just some guy on YouTube, so you shouldn't be listening to me. And for that matter, really, you shouldn't be listening to any of the guys on the YouTube. You should be making your own decisions. I watch them too. I like a lot of them, but I do make my own decisions on all this stuff. I do like to watch an awful lot of markets. I still watch the currencies because that's what I traded at the mercantile exchange. I watch metals, I watch equities, but what I really hope people do, what my real goal when I started this channel was, well, A, I like this stuff, so it gives me an outlet to talk about the things I like about. But B, my real hope is to encourage people to learn to save. I talked to my son about it. He's 13 years old. The real advantage is the most amount of time and the most you can put in early on. So that's what it comes down to. The earlier you can put money away and the longer you give it, it tends to grow over time. The guy on Real Estate Mindset, I saw him thrown off a little bit when somebody in the comments asked about what he pictures real estate in the next 15 or 20 years because he sees a correction coming. And to be fair, he notes a lot of good data points. My problem with data points is they're not unknown. Like people are well aware of all those data points. So it's hard to imagine that you have some insight that nobody else does. So I just try to go off of prices and what I see going on. But I saw that the question kind of threw him off because what he wanted to say is in 15 or 20 years, he sees prices being higher, which is what I do as well. I think if you give it the time, it goes higher. I can't predict what it's going to do next year. Maybe something comes around to cause a 20, 30, even 40% correction. You can never see a correction really coming. It's hard to see that. But in the long run, I think we all think that things will be worth more in time. Unless something dramatically changes in terms of human and inflation and growth and whatever else, prices on everything tend to get more expensive over time, the more people there are, and the more that we get used to the old prices. It just kind of goes that way. So if you're looking long term and you're thinking about buying something 10, 15, 20 years or owning it forever, just put it away and hope it continues to grow. And I sure don't see commercial real estate being the thing that just draws us down. The government and the banks are well aware of what's going on with the commercial real estate. They're way ahead of it. It's not going to be any shock to the system. The other thing with those loans that are different is they're non recourse loans. And a lot of the people who've bought those properties that have their mortgages rolling, well, generally the way that it works is they're taking out and leveraging as much money as they can to continue and do more. If they've been refinancing them as the properties have been getting more expensive, they probably have cash in their pocket and they don't have to take the loss. They can walk away from the property. That's what non recourse means. So the banks really don't want to be stuck with those properties. And if they are, they probably have 30, 40% equity in them in terms of trying to get out and not necessarily taking a loss. So I just don't see it being this thing that's going to catch everybody off guard. And my guess is the government's already decided, or at least has some good ideas on how to help if there becomes a problem with it. I don't see it dragging down the whole economy. The only thing that's tough about it is it's hard to value the properties because they're really valued based on the rent. But some of them have gotten so old that they're not worth converting to residential properties, and then probably not even worth knocking down and building because it's probably too expensive. So they're just these old buildings that are hard to price. Now, again, I'm sure that they're discussing the options. I know somebody through somebody, so forgive that the story isn't direct, but it's through somebody I trust the information through. But a friend of theirs who has two commercial properties that went to the bank because he's coming upon that time, and the bank doesn't know what to do. They don't want him to refinance, and at the same time, they don't want the keys. Now he's one of those examples. He's refinanced so many times, he's taken out cash and doesn't owe it. Like in his mind, he's taken out tons of money. And even though technically he has 25% equity on the building, it's not, he doesn't feel like it's out of his pocket. And he could care less either way. And he almost thinks the situation is kind of funny because the bank won't take the keys, but they aren't in the position to refinance him at the new rates. So they are just letting him make his old payments and, go month to month until they can figure out a solution. Well, my guess is he's not the only one. Anyway, again, don't forget to give the thumbs up, like, subscribe, make some comments. Let me know what you guys think about the economy. Do you see that collapse coming that some of the other people do? It's totally reasonable opinion. I just have a different thought on it. Like I think the economy's tough. We don't like inflation. Not only have I had inflation, I have less income when I have more time, which is why I do these videos. But it just means a change of what we pay attention to. Anyway, I'll keep rambling, so I'll shut up now. Thumbs up, subscribe, comment. Have a great day. I'm sure I'll talk to you this weekend.